Welcome back to Gold Rush Reporter. Today's story is not about politics. It is about shock risk and how markets react when uncertainty hits all at once. By now, many people have heard reports about a US military operation in Venezuela involving the removal of Nicolas Maduro. Whether every detail is accurate or still unfolding is not the point. Markets do not wait for full confirmation. Markets react to headlines, fear, and uncertainty. And what happened after those reports, particularly the official statements and press conference, is far more important than the military action itself. Because when geopolitical risk appears suddenly, capital moves fast. And when capital moves fast, gold, silver, and energy react first. That is the framework you should be using, not emotion, not ideology. Let's establish something immediately. Venezuela is not a small player in global resource geopolitics. It sits on massive oil reserves, and it is located in a region that matters for shipping routes, alliances, and supply chains tied to metals and energy. When the US signals direct involvement, military or administrative, the market response is almost automatic. Risk assets hesitate. Safe haven assets gap. This is why analysts are already discussing a gap up open for gold and silver when markets reopen. Now, what does gap up actually mean? It means prices do not move smoothly from Friday's close. Instead, they reopen significantly higher, skipping intermediate levels. That usually happens when markets are closed, but information keeps flowing. Right now, markets are closed. Information is not. That creates pent-up pressure. Gold closed around 4,330, silver around 7,270 on COMEX. Those numbers may be irrelevant once trading resumes. Not because fundamentals changed overnight, but because risk perception did. Here is where many commentators go wrong. They assume this is only about Venezuela. It is not. This is about precedent, supply chains, and strategic metals. Whenever the US directly intervenes in a resource-rich country, markets immediately ask three questions. Will supply be disrupted? Will trade routes be affected? Will rival powers respond indirectly? Gold and silver are sensitive to all three. Silver especially is no longer just a precious metal. It is a strategic metal. It sits at the intersection of energy, defense, electronics, and infrastructure. Any geopolitical tension that threatens trade routes or resource access raises silver's risk premium. This is why silver often reacts before the data confirms anything. Now add oil to the equation. Oil prices tend to spike on geopolitical shocks, even when the actual supply impact is unclear. Venezuela's oil matters not because it disappears overnight, but because control, rebuilding, and export policy take time. Time equals uncertainty. Uncertainty equals volatility. And volatility drives capital into metals. But there is another metal that deserves attention here: copper. Copper is increasingly treated as a strategic asset. Tariffs, stockpiling, and export controls are already distorting its market. Any regional instability tied to shipping lanes or alliances can move copper sharply. So when analysts talk about gold and silver gapping up, copper should not be ignored. Now let's be disciplined and honest. This does not mean metals go straight up forever. This does not mean you chase prices emotionally. Geopolitical spikes are often fast and violent, followed by pullbacks once information stabilizes. But here is the key point most people miss. Even temporary shocks reveal fragility. They expose how tight supply really is. They expose how dependent markets are on smooth logistics. They expose how fast sentiment can flip. And when you combine geopolitical shocks with an already stressed silver market, structural deficits, regional price disconnects, strategic demand, the reaction can be stronger than people expect. Now let's move past the headlines and focus on mechanics, because markets do not trade narratives, they trade consequences. The most important issue here is not whether every reported detail is confirmed. Markets respond to risk to supply chains, not courtroom-level certainty. When military action is reported in a resource-rich region, traders immediately price in disruption risk. That is exactly what is happening here. Venezuela sits near critical shipping corridors that connect South America to global markets. Even if Venezuela itself is not a major silver exporter, instability in that region affects neighboring exporters, insurance costs, routing decisions, and delivery timelines. And this is where silver quietly enters the picture. Countries like Peru and Chile are among the world's largest silver exporters. Their shipments move through routes that become more expensive and less predictable when regional tensions rise. You do not need a blockade to disrupt trade. Higher insurance premiums and rerouting alone are enough to slow flows. Slower flows mean tighter availability. Now combine that with a silver market that is already running structural deficits. This is not a one-year issue. The silver market has been undersupplied for years, with demand consistently exceeding mine output and recycling. In that context, even small disruptions matter. This is why analysts are projecting silver to test higher levels, 75, 78 or beyond. Not because of hype, but because risk premiums expand when supply certainty declines. But silver is not the only metal affected. Copper deserves serious attention here. Copper is essential for electrification, infrastructure, and defense systems. It is already under pressure from tariffs, strategic stockpiling, and long-term underinvestment in new mines. When geopolitical events raise the risk of trade disruptions, copper often reacts alongside silver, not as a safe haven, but as a strategic necessity. In other words, gold reacts to fear. Silver reacts to fear and supply stress. Copper reacts to supply stress first. This is why watching copper alongside silver makes sense right now. Now let's address a common misconception. Many people believe that because Venezuela's official silver production is limited, silver should not be impacted. That is shallow analysis. Markets are interconnected. If silver that normally flows to China, Asia, or Europe is delayed or redirected, even marginally, buyers elsewhere must compete harder for what remains. That competition shows up in regional premiums, not immediately in COMEX futures. This is exactly what we have already been observing in other parts of the world. Physical silver prices in Asia and the Middle East are already trading far above Western paper prices. That tells you the market is tight before this geopolitical shock. So when a shock hits, it does not create stress. It reveals it. Now add China to the equation. China is deeply invested in securing raw materials. Any signal that the US is willing to directly intervene in resource-rich regions sends a message to Beijing. Supply chains are political. When supply chains become political, nations prioritize stockpiling, not market efficiency. Stockpiling removes metal from circulation. Removed metal tightens supply. Tighter supply raises price volatility. This is not speculation. This is historical pattern. We have already seen China move aggressively to secure silver, including importing unrefined material and tightening export controls on other strategic metals. Silver sits at the center of China's EV, solar, robotics, and defense industries. They cannot afford interruptions. That means any global instability increases China's incentive to lock in supply, regardless of price. And when large players stop caring about price and start caring about access, markets shift fast. Now let's be honest and disciplined again. This does not mean you rush into trades based on a Sunday night gap. Emotional buying during geopolitical spikes is usually punished. Short-term moves driven by fear often retrace once clarity improves. but the longer-term signal matters more than the initial spike. These events reinforce a larger trend. Silver is becoming strategic, fragmented, and increasingly sensitive to geopolitical stress. That is not a bullish slogan. That is a market condition. Now let's focus on what happens when markets actually reopen, because this is where most people misunderstand volatility and make bad decisions. When futures markets reopen after a geopolitical shock, the first move is almost never the true move. It is a positioning move. Traders are not responding to fundamentals in that first hour. They are reacting to headlines, risk models, stop losses, thin liquidity. That is why gap-ups happen. If gold and silver open sharply higher Sunday night, that does not automatically mean a new trend has begun. It means risk was repriced while markets were closed. The key is what happens after the gap. There are 3 scenarios you should be watching for. Scenario 1. Prices gap up and then consolidate at higher levels. This tells you that buyers are willing to hold risk despite uncertainty. That is a sign of underlying strength. Scenario 2. Prices gap up and then fade hard. This tells you the move was mostly emotional and driven by short-term hedging. That is common, but it does not erase the longer-term issue. Scenario 3. Prices gap up, pull back slightly, and then grind higher. That is usually the most bullish structure, because it means sellers cannot push price back to prior levels. Which scenario unfolds depends on one thing: follow-through demand. Now here is where silver differs from gold. Gold is held primarily as a monetary hedge. Silver is held as a hybrid asset, part monetary, part industrial. That makes silver more volatile, but it also makes silver more sensitive to supply disruption narratives. If industrial users believe there is even a small chance that supply routes tighten, they hedge by securing metal. That buying does not show up immediately on futures charts. It shows up in physical orders and regional premiums. So while traders watch COMEX candles, the real signal is where the premiums hold after the initial move. If silver gaps up and premiums remain elevated, that tells you physical demand is absorbing volatility. If premiums collapse while futures spike, that tells you the move was mostly paper-driven. That distinction matters more than the headline price. Now let's address copper again, because copper will quietly confirm or reject the narrative. Copper does not rally on fear alone. It rallies when supply concerns are credible. If copper prices strengthen alongside silver after the reopen, that tells you markets are pricing logistics risk, not just geopolitics. If copper stays flat while gold spikes, the move is mostly risk-off hedging. This is why watching multiple metals gives you better signal than watching one. Now, let's talk about China's likely response again, because this is where medium-term impact comes from. China does not react emotionally to headlines. It reacts strategically. If China interprets US actions in Venezuela as part of a broader resource containment strategy, it accelerates resource security, not diplomacy. That means more bilateral deals, more off-market purchases, more inventory taken out of transparent systems. This matters because silver is already fragmented geographically. Western markets rely heavily on paper liquidity. Eastern markets increasingly rely on physical settlement. Every time a large buyer bypasses exchanges, available float shrinks. That does not show up immediately in price, but it shows up eventually in instability. And instability is where silver reprices. Now let's challenge an assumption directly. Some people believe that if prices pull back after the reopen, the entire story was nothing. That is lazy thinking. Short-term pullbacks do not negate long-term stress. They often mask it. Geopolitical events act like stress tests. They reveal where markets are fragile. If silver reacts violently to headlines, that tells you it is already tight. Loose markets do not behave this way. Now, discipline matters here. This is not a call to chase Sunday night volatility. That is how people get chopped up. This is a call to observe structure, not emotion. Watch. Whether silver holds above prior support. Whether premiums stay elevated. Whether copper confirms. Whether physical availability changes. Those signals matter more than a one-day move. Now that we understand the immediate market reaction, let's step back and consider the broader implications for silver, gold, and strategic metals. This is where short-term shock moves turn into structural shifts. First, silver's status as a strategic metal is becoming increasingly relevant. Unlike gold, which is primarily a monetary hedge, silver sits at the intersection of industry, technology, and energy. It is critical for solar panels and renewable energy, electric vehicles, EVs, electronics and robotics, defense and military applications. When a geopolitical event threatens supply, even temporarily, industrial users respond faster than traders. They secure contracts, stockpile, or hedge through physical purchases. That demand is inelastic. It cannot be postponed without operational consequences. This is key, because it explains why silver often reacts more violently than gold during geopolitical shocks. Gold rises on fear, silver rises on fear and supply stress. And supply stress is what events in Venezuela are exposing. Now let's focus on supply chain impact. Venezuela itself may not hold enormous silver reserves, but it is connected to global shipping and regional trade routes. Neighboring countries like Peru and Chile are major exporters. Any disruption in shipping lanes, whether through military presence, blockades, or insurance hikes, reduces availability, increases delivery times, and raises premiums. Markets see this risk immediately. Copper behaves differently, but confirms the pattern. Copper is industrial only. Its price responds directly to supply disruption rather than fear. If copper moves alongside silver during this Venezuelan event, it signals that physical constraints are being recognized by global markets, not just emotional reactions. Next, consider the China factor. China is the second largest producer and consumer of silver. It imports unrefined silver from South America, secures domestic production, and stockpiles for strategic purposes. Any disruption in global supply or perceived US control over metals drives China to accelerate acquisition. This removes metal from global circulation, further tightening supply outside the US and creating an asymmetric market where regional premiums diverge. The interaction between Western paper markets and Eastern physical markets matters here. COMEX silver prices are often detached from physical realities in Asia. When supply shocks occur, Asian and Middle Eastern buyers prioritize physical acquisition. This divergence exposes Western traders to sudden repricing if the flow of metal shifts towards strategic buyers. This is why events like Venezuela's disruption are not short-term blips. They accelerate long-term structural tightness. Each geopolitical shock compounds existing deficits and increases the strategic value of silver and other critical metals. Repeated shocks shorten the paper lag, forcing physical supply to dominate price discovery. Now, consider market psychology. Investors may see a pullback after a gap-up open and assume the event had no impact. That is a mistake. Short-term retracements are normal in volatile markets. What matters is positioning and premiums. If premiums remain elevated, if physical supply is harder to access, the market is already factoring in long-term scarcity. Finally, this is not a call to panic buy. Discipline remains essential. Successful positioning requires observing how physical premiums behave post-shock, whether copper confirms silver's movement, whether risk-adjusted gaps stabilize at new levels, how industrial users adjust their procurement. These are the actionable signals, not the headlines, not the politics, but the flow of metal and capital. Now we arrive at the medium-term implications of these events in Venezuela and why this matters for anyone following silver, gold, or strategic metals. Let's break this down logically, step by step. First, consider what we've seen so far. A sudden geopolitical event, a US intervention in Venezuela, creates immediate market volatility. Gold gaps higher on fear. Silver gaps higher on fear and supply stress. Copper reacts as a signal of industrial concern. But short-term moves are only the surface. The real story is structural. How supply chains, regional premiums, and strategic demand interact over weeks and months. Silver is increasingly a strategic asset, not just a precious metal. Its importance in solar energy, EVs, robotics, and defense means that any disruption in supply, even minor, can have outsized effects on demand. Industrial users cannot simply pause purchases. Production pipelines depend on consistent metal flows. When these flows are threatened, either by regional instability or deliberate strategic moves, it forces a repricing of silver in real-world markets. This is compounded by the geopolitical split between Western paper markets and Eastern physical markets. COMEX and LBMA prices reflect Western futures and paper contracts. Meanwhile, Asia and the Middle East are increasingly trading physical silver at higher premiums. The gap between paper and physical is widening. These gaps are not temporary anomalies. They are indicators of structural stress. Now let's factor in China. China is both a producer and a voracious consumer of silver. Any perception that US actions restrict access to strategic metals pushes China to accelerate stockpiling. When large buyers prioritize access over price, they remove metal from global circulation. That creates scarcity outside of the Western markets, driving premiums higher in physical markets, even if COMEX prices lag. Next, consider Venezuela itself. Official reserves may be modest, but reports, verified or unverified, suggest some silver could have been moved to China or Russia before the US intervention. Even if this is partially accurate, it shows how geopolitical events can redirect supply flows, affecting global pricing indirectly. Oil control is another factor. The US plans to secure Venezuela's oil infrastructure, which adds leverage in the broader resource landscape. Oil, copper, and silver are interconnected in terms of industrial strategy, investment, and market sentiment. For investors, the key lesson is this: don't chase headlines, follow structural signals. Emotional buying during the initial gap up will often be met with pullbacks once early volatility fades. What matters is whether physical supply tightness persists, whether premiums remain elevated, and whether strategic buyers continue to absorb metal outside Western paper markets. These are the signals that indicate long-term market repricing. Dollar cost averaging and disciplined accumulation remain the best approach. Do not over-leverage or assume that a one-day spike dictates the year ahead. These events are part of a long-term narrative of constrained supply and growing strategic importance. Markets may fluctuate violently in the short term, but persistent scarcity and strategic demand will eventually assert themselves. Finally, keep monitoring the broader picture. Physical premiums versus paper prices. Copper movements as confirmation of industrial stress. Trade route stability in South America policy and stockpiling actions from major consuming nations. These factors will determine how silver and related metals behave in the medium term. To summarize, the US intervention in Venezuela is not just a geopolitical story. It is a market stress test that exposes fragility in the silver market, highlights strategic importance and demonstrates how supply, access, and industrial demand intersect. Short-term volatility may mislead casual observers, but disciplined analysts see this as a continuation of structural trends already in motion. This is Gold Rush Reporter, bringing you precise analysis on silver, gold, and strategic metals. Stay informed, watch the flows, and remember, it's access and structure, not emotion, that drives markets over time. We will continue monitoring these developments closely and break down the next market reactions as they unfold.